It does take us to our talk of the tape. Don't fight the Fed. That's saying especially notable today on that Hassett report and the move in the Treasury market. For more on what it all means, let's welcome in our panel. Trivariate's Adam Parker, PNC's Young Yuma, and Requisite Capital's Bryn Talkington. Bryn and Adam are both CNBC contributors. This is great to have everybody with us. Adam, you first. I mean, we talk all the time. Don't fight the Fed. Don't fight the cuts. Don't fight the Hassett. Maybe the market is thinking about that today.
Yeah, I mean, the poly market had him in the lead anyway. So I don't know if it's that surprising, to be honest with you. When I was writing over the weekend, I thought the sell-off last week was not about the Fed getting hawkish because the bond market was really stable. So, yeah, I think people are positioned in equities because they think the outcome for the Fed is skewed to the dovish. But at some point, I think 2026 is going to be the year where we get close to being done with the accommodation, and that might mean the Fed part of the bull case is less compelling.
Did we overdo the worry about AI last week, or what was that all about, you think?
Yes. And I think we did overdo it, and I think it was mostly, when you decompose it, a couple technical things in the market, some hedge fund selling, some delevering, some ETF selling, some short gamma positions. So it's technical stuff, because the fundamentals, I think, are still quarters away from showing any weakness.
Young, you're pretty positive on the market, aren't you? You don't think, you think the Fed is going to cut in December, right?
Yeah, definitely. I do think there's a very high likelihood the Fed will cut in December. Once John Williams came out and gave positive comments about cutting, I think a lot of Fed members are on the fence, will fall in line behind that, and I think the prediction markets reflected that.
Yeah, because it was, I think the thought was, okay, December's 100%, then December was close to 0%, and now we're back moving towards 100% for December. I mean, is there any risk in that for the rally here?
Well, I think what the risk is the messaging when the Fed cuts rates, because we do think that's going to come in December. I think when the Fed cuts, what's the messaging? Is it a hawkish cut? Is it more of a data-dependent, let's see where things go? Or is it more messaging that we're probably at a pause level for the foreseeable future? So I think that's where the risk probably comes in here. But I do think that incoming data will probably be on the soft side and will lean the Fed toward dovish in 2026.
Bryn, is that then overall bullish for where we go from here, despite some chop we might have or some increased volatility?
I think it has to be, because if we can actually get long rates to come down, as you pointed out, as they have today, plus don't forget we have midterms. And the second year of a presidential cycle is typically the best of the four. Midterms, I think, are going to be incredibly important. And so I think the fiscal side of the economy will start to get juiced from the OBBB. If you get rate cuts and the long end stays down, that's great for housing. That's great for hard assets like real estate. And so I think it can set up where GDP and the economy are actually starting to pick up. And the key will be, obviously, if those inflation signals can stay anchored. But I definitely say between earnings, don't fight the Fed, which I'm a big fan of. Even if they're coming kicking and screaming, that definitely bodes well for the economy. And with earnings backing up the economy, I think that would point signs that the market will continue to go higher.